at Chapter 10, Standard Costs and Variance Analysis. So in Chapter 9, we learned to do the master budget. And that's a budget that's made for one level of sales value. So in our example that we used for Chapter 9, we talked about Texas Rex, and that they had $57,000 of sales that were expected for the next year. So the entire master budget, all the way down, was based on that one level of sales volume, $57,000. Now they broke it up into 4 quarters, but if we end up selling more or less, that whole budget becomes difficult to compare once we get to the end of next year and we have all our actual numbers. We want to compare our actual to the budget. And if we end up selling $60,000 worth of sales and all the extra expenses that go with that in our actual, and then we're trying to compare that to a budget that was made for $57,000 worth of sales, it'll be like apples to oranges. For the manufacturing company, in the master budget, we show direct materials, direct labor, and overhead budgets. If we were a merchandising company, we would just have the purchases budget. Okay, these budgeted revenues and costs are based on expected amounts, which are called the standard costs, and we'll talk about those in a couple minutes. Now this discusses the flexible budget. A flexible budget is based on the master budget. So if the master budget, in this case here for this example, the static budget, which is the master budget, is based on just one volume, in this case 50,000 units we think we're going to sell. We base our whole master static budget on that 50,000 units that we're going to sell. Well, the flexible budget takes that master static budget and then makes some extra budgets that are based on sales amounts that are lower than the master and higher than the master. So in this case, we would end up with 5 budgets. The master budget that fits in the middle, and then 2 that are lower and 2 that are higher. If we get to the end of next year and we see that the actual sales volume turns out to be 52,000 units, then we're going to use the flexible budget for 52,000 units to compare to the actual cost that we had for 52,000 units. Now we're comparing apples to apples. And then that way we can see if the difference or the variance between what we actually had and what we had budgeted for that amount of sales, how different is it, and then we can investigate that and see why did those variances happen. Now, these flexible budgets are based on the master budget. So the master budget has to be completed first. And then it's very easy to get these flexible budgets because they're all just based on the same standards that we use to get the master budget. So you can do this easily, get these flexible budgets easily on Excel by putting that master budget in and then have all your formulas in, and then based on these standards, and then you can put any number of units on the top columns in front of and after the master budget units, and boop, 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 the whole flexible budget is done. All right, so for standard costs that we need to make both the master budgets and the flexible budget is based on, okay, what is it? Okay, a standard is It's the price, the cost, the quantity, whatever it is that is expected under normal conditions. And these standards are usually set for materials, labor, and overhead. So sometimes a company will set a standard based on ideal conditions, but that doesn't work out so well. So if ideally, if everything is perfect, the traffic is flowing good, the one traffic light I have to go through is green, okay? Ideally, I can get to work in 12 and a half minutes. Does that mean I should set myself to leave the house exactly 12 and a half minutes ahead of time to get to work? No, because invariably stuff happens. The traffic is slow on I-26. That light is not green. Some other something has happened. I need to stop for gas. Whatever. Okay? Stuff happens. And so, and stuff happens more normally than the days that are ideal. And so, typically, I should set my standard for how long it takes me and when I should leave based on stuff happening. Now, I don't have to say, oh my gosh, you know, the whole I-26 could be completely blocked, there could be an earthquake, blah, 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 and therefore I should leave an hour ahead of time every day. Well, no, that's going the other way. But we do want to take into consideration the normal conditions, okay? And when we're setting for materials, labor, and overhead, the best way to do that is to set the standards based on normal conditions. So here's an example. At Premium Pooch Palaces, and we've done some projects on them, expects that it takes 32 shingles for a particular doghouse model, and each shingle is expected to be 50 cents. Those are the standards. The 32 shingles is the standard quantity of shingles for that model of doghouse. The 50 cents is the standard cost for shingles, which is a direct material. Okay, so we're going to do the same thing for labor. We're going to figure out how many direct labor hours are there normally to build a particular model of doghouse, and what do we expect to have to pay per direct labor hour, the cost per hour for that direct labor. Then we have overhead, and we have our variable overhead, and we can also take a look at how much do we need and how much does it cost per cost driver that we're using for the overhead. To get these standard sets requires coordination among managers and accountants of different divisions. So it's not going to be some bookkeeper buried in a back office who's going to decide, oh, it takes 32 shingles and 50 cents a shingle. Okay? We're going to have to get the purchasing department manager in here to talk about the cost of shingles, what he's expecting in the future, etc. And the 32 shingles, how many, we're going to have to talk to the foreman, the top supervisors in the factory building on how many shingles it takes. We're going to talk to various accountants that help to do the accounting for these things, to see if those are good amounts, etc. So if you got one person at the top who's just saying all this stuff, it's more than likely it's not going to be as well done, and then you're going to have a bunch of problems. Okay? So the standards, once we figure out what the standard is, once we figured out it takes 32 shingles and 50 cents per shingle, okay, we shouldn't change either of those unless there's an actual change in quantity or cost. maybe we make a change to that model and we add an extra section of roofing, then we would need extra shingles. Okay? Maybe there's a giant set of hurricanes, and for the next 5 years, shingles are going to be more like 58 cents a piece instead of 50 cents a piece. Okay? We don't want to change the standard just because something happened this 1 year, and by the end of the year, it's all going to go back down to normal. Okay? We just keep our standard the way it is, unless there is a more permanent, definite change, and then we'll go ahead and change the standards. Variances means the differences. This is the difference between the actual revenue, actual sales that we had compared to the budgeted sales that we thought we were going to have. The difference between the actual cost that we spent for materials, labor, or overhead, selling and administrative expenses, whatever it is, the difference between what we actually had and what we had budgeted. Now, variances are favorable or unfavorable once we figured out that difference. It's called favorable if it increases operating income. It's called unfavorable if it decreases it. You have to be careful, however, to not confer. Favorable sounds like, oh, that one's good, and unfavorable says, oh, that one's bad. Sometimes that's true, and sometimes it's not. So don't get caught up in good and bad, okay? It's just F, favorable, if it increases operating income, U, unfavorable, if it decreases it. Variances are analyzed to determine the reason. That's the whole reason we're doing this, is to find the reason, to be able to investigate and figure out why did the cost of the shingles go up? Why did we have to use 36 shingles for that model instead of 32? Why? Okay? Who is responsible? Not necessarily that that person is going to get in trouble. I mean, if there was a hurricane and shingles across the country are now 58 cents, that's not the purchasing director's fault, but the purchasing director is who we're going to go to find out why did the shingles go up to 58 cents a piece. Okay? And if that's going to be a more permanent change, we're going to ask that purchasing director. So we need to know, we need to be able to break out all these variances into who is responsible, and we can investigate, find out why these differences exist. So here's the example. If the cost of the shingles turns out actually to be 58 cents a piece rather than 50 cents, the variance will be investigated with the purchasing manager to see why the cost increased. If a different vendor maybe could be used. If this is a permanent change and we need to change the standard itself. The flexible budget performance report lists the budget amounts for revenues and costs, compares them to the actual amounts, along with the variance, which is the difference between the actual and the budgeted amounts. And so it will also show 2 columns of variances, the sales volume variance, which is the difference between the static budget and the flexible budget of the actual number of units sold. Okay, and so we're less concerned about that. The flexible budget variance is the one that we're going to actually do that shows the difference between the flexible budget and the actual results for the